Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Welcome in, Nick Bernatowicz.
Thank you.
So today we're specifically talking about the main thing. And what is the main thing for us in our business?
The not so dirty word.
Annuity.
Annuity.
That is right. We are talking about annuities. I would contend that today, as we sit here, annuities are now in vogue.
Man, and for me,
would you disagree?
How refreshing, right? I came into this industry.
What year?
14, 13?
Okay.
Would it have been around there? 14.
15.
Danielle's got
15.
me.
Okay, I was 2001 when the world began to unravel through the tech bubble.
Okay.
You came out years post financial crisis. So I've lived this industry for two
cycles.
Two not so fun cycles.
Yeah.
Now in that to set the context here, when I first was born into the business in 2001, we obviously had the situation of the tech bubble. The 10-year treasury was somewhere in the, and don't quote me on this, but it was definitely in the 9% range, something along that line. And what then ensued was a long-standing erosion of the 10-year treasury and interest rates for many, many years. Here we are. For the tenure of your career in this business, interest rates have essentially been darn near zero.
Treasury's been under 3 the entire time. And that's a huge fact that many of our advisors do not know, that the 10-year treasury is the benchmark for which annuities are priced, amongst other things. But that is, just because the Fed's increasing rates does not correlate to higher annuity rates.
Misconception number one.
Yes.
Relating to the pricing and I would say the sizzle or the attractiveness in terms of rates as it relates to annuities, it is not directly tied to the Fed funds rate. As all tides rise, you would then think there's an indirect correlation to the 10-year treasury and all of that. But although in 2018 in particular, the Fed was raising the rates, somewhere around 2.5 is where it peaked. The 10-year treasury was nowhere near that, where we're seeing it today. Fast forward to now, Fed, as of today, the Fed raised another 75 basis points. So here we are. The Fed funds rate is going to be sitting between 3.5% to 4%, somewhere in that range, with probably another rate hike imminent. So you're going to be at 4.25%, 4.5% as the Fed funds. With all that said, a year ago, the 10-year treasury rate, what's your guess? What was it at?
A year ago.
So November of 21.
November of 21.
The market was peaking.
Yeah, it was around 2.
1.5.
Oh man.
Yeah, 1.5, 1.48, 1.53, somewhere in that range. Today, 4.1. What does that mean? What that means is we finally, since 2007, are seeing very attractive rates that I have not seen for many years, 15 years. So annuities are now currently in a state where they can almost sell themselves.
I don't know about that, but you got to break down some of those misnomers and misconceptions on what are annuities and their benefits and disadvantages of. But yes, rates are extremely attractive, and no better time to put a solution in place that's protected against market losses with this volatility that we're seeing this year and last.
Yeah, no, there is, in all seriousness, there is no one solution for anybody. There are also multiple types of annuities for any of our advisors listening or audience listening. It is important to understand the basis of what an annuity is. Number one, that's not necessarily the conversation we're having today. You can easily find that information out or give us a call.
Or our previous podcast episode, we did talk about Annuity 101.
Very good point. Maybe you could pull that up and we can Danielle, we can go back to that. However, there are many types of annuities that serve different purposes. Single premium annuities, deferred income annuities, fixed rate annuities, multi-year guaranteed rate annuities, variable annuities, registered index linked annuities. What am I missing here? Fixed index annuities. So there's many different types of annuities that cater to different needs, different clients, diversification, even amongst a specific, let's call it an asset class like an annuity, is very important. 2021, the total placement of annuities, you have any guess?
No.
It's a massive number.
I literally have no basis.
Okay, so one of the lowest selling segments of the annuity business would be in this traditional single premium immediate annuity, which is around $6 billion.
$6 billion.
$6
That's
billion.
the smallest.
That's it probably is the smallest.
Okay.
It's one of the lowest categories. Registered index-linked annuities, which is probably it is the fastest growing segment of annuity
new
sales.
product set. Yep.
$39 billion in sales in 2021, which was a 62% year-over-year increase. Wow. So clearly, that is the gainer, the fastest growing
share.
Space. Now,
yeah.
Total annuity placements $255 billion
with a B.
With a B. Now, the next thing I want to talk about is the landscape of annuities. The FIA marketplace is how much? Danielle's pulling up the slide.
66.2 billion.
Yeah, 66.2 billion is the annual 4-year average of FIA sales. And the adoption rate institutionally is what I want to talk about, has been rapidly increasing and developing. So banks are up over 4 years.
38%, independent BDs 86%, full service BDs 63%. Yeah.
So somewhere between 38 and 68% increase over that period of time in adoption rate of fixed indexed annuities. Well, why is that?
Market conditions. One.
Market conditions.
We have in the last 10 years, really the real downturn we've had to weather. What are we year to date? What's market down? 30% right?
Right.
So that's the first time in 10 plus years that we've seen that. So people are flighting to safety somewhat,
right.
or they're looking for a solution to give competitive yields with protection from downside exposure. So that would be one.
Right.
New products subsets being introduced, like the registered index-linked annuities, product innovation, even within the indexed annuity space, making them more attractive, better investment options. I don't want to say investments because you're not directly index options within those products. Would probably be another reason, just simple product innovation.
And adoption, or I would say more and more institutional carriers, as well as institutional companies like BlackRock, like Fidelity, have like Morgan Stanley, JP Morgan, Goldman Sachs, are now also entering into the space through the integration and creation of some of these indices that are available on index annuities. So more and more you're seeing, the general financial marketplace enter into this space. I think that's an element of it. The other part you have is, we've been talking about this for many years, banging our head against the wall, if you will, but consistent with our story of the market is, long in the tooth. It's been a heck of a ride. It's been a heck of a run. Clients should consider, as they age and approach retirement, diversification, taking some of the chips off the table, moving from, let's call it equities and maybe even some fixed income, and repositioning those into something like a fixed index annuity that gives the client the floor of zero. You certainly are efficient in terms of pricing of fee structure, whether it's a commission-based or a non-commission-based product. But never, I think certainly in your tenure and for probably the last 10 or 15 years, I would challenge that the sequence of returns risk for retirees has never been greater than it is right now. And we're seeing that play out right in front of our eyes where, let's just talk about year to date. Are stocks, i.e. equities, positive or negative for the year?
Negative.
Negative. S&P year to date is down 16.5%. The Dow Jones Industrial Average is down close to half that at 9.5%. And the NASDAQ tech has been hit pretty hard at a negative 30. Well, let's talk about something exotic. An exotic option is digital assets in a positive or negative state.
No.
They're negative. Fixed income, so bonds, negative. What asset class is performing?
So be it, annuities.
That's right. It so happens to be,
Yeah.
right? Like, finally,
it is the asset class that is performing.
what are we
how it
seeing?
should.
What are we seeing today in terms of products that you're conversing with our advisors on that are being purchased, and what do the rates look like?
Yeah, it's no longer the days of 10-year contracts, 12-year contracts, 14-year contracts. Those are all gone. We're seeing short duration annuities as short as 3-year contracts, but
And are they attractive?
very attractive.
Okay.
So just
What are we seeing in rates?
so 3 to 7 year products, that's the sweet spot. We're seeing most commonly sold the 5 to 7 year contract, and on a 3-year, if you're looking at a guaranteed fixed rate, you're gonna be somewhere in the ballpark of 4.5% on a guaranteed rate. On a 5-year, you're gonna get 5.25% guaranteed annualized yield there. On index annuities, your cap rates on a 7-year contract is going to be somewhere around 12%. And those even have a built-in fixed account, usually around 4.5 or 5. So they're extremely attractive. If you do the simple math on a 12.5% cap or a 12% cap on a 7-year contract, the client simply needs to cap out 4 of those 7 years to have extremely competitive yield. You're talking 7-8% on a 4-year cap out. So that means they could have 3 zeros out of the 7 years and still have an extremely competitive product with no fees, no market risk, have liquidity, it's tax deferred. That's why they're attractive right now, not just because of the rates, but because of all the ancillary benefits that come with an annuity as well.
Yeah, the other part of it, I think, is through this adoption rate, through these conversations that not just we are having, but insurance companies, the financial institutions are beginning to have because they're adopting these products. It's becoming hopefully more of this is a product, this is an instrument that I should be inclusive in a well-diversified portfolio.
Yeah, it's actually pretty frustrating when people hear annuities. They normally think of variable annuity or they think of a SPIA, a guaranteed income annuity.
Annuitization. The function of that an annuity can
Correct.
provide.
So even when we got our RICP from the American College, right, and we go through this whole course, they barely touched on other subsets of annuities. It was variable SPIAs mainly that they talked about. And as they gain more traction, that'll come more in the forefront. When you have, Dr. Wade Pfau writing white papers on it and Kitchis doing articles on it, those really are helping bring it to the forefront. BlackRock, these big institutions are promoting them more, and it's going to help with the overall adoption of what these products are available to consumers.
We talk about 2 main categories at the highest level that an annuity can provide. One is
Income.
The other is
Accumulation.
growth. Yeah.
Growth.
Absolutely. Accumulation. Let's talk a little bit about income planning. And this is a very interesting thing where advisors, we feel, understand that they need to understand that annuities are a diverse product that can provide multiple solutions. And it's a very efficient instrument to provide income, and in particular, guaranteed lifetime income.
What a lot of people don't know is Social Security is an annuity, right? It is a guaranteed lifetime annuity being offered by the government.
Right.
Pensions with companies are annuities. They are a specific type of an annuity, a single premium annuity or a deferred income annuity, as you stated. So it doesn't have to, as I started this entire thing, it doesn't have to have the dirty word annuity. You have annuities built into your life already. You just don't know it.
Right. So on the topic of income planning, I wanted to pull up this graphic that we use from time to time to illustrate this. And I think this is very, very important and powerful. You know, what we found is that depending on the circumstances, given age of the client, amount of capital in total, and time horizon, right? A given client can gain anywhere between 10 to 40% more income or be more efficient with their capital than a traditional portfolio. And so what this shows you here, looking at some of the examples on the right, so retirement income, 6% systematic withdrawal percentage would require $583,000 to meet a $35,000 income. And we're saying the retirement age is at age 70. Now, if I'm looking at a retirement income 5% withdrawal, then it's a $700,000 capital need. And if the withdrawal rate, which most are going to benchmark as kind of the standard withdrawal rate for retirement at 4, it actually requires $875,000 of capital to deploy that income. Now, looking at the dark blue category to illustrate this is looking at different guaranteed cash flows using an annuity based on time horizon, in other words, deferment period. And starting on the left, a guaranteed income 10 years before. So if I had purchased the annuity at age 60, waiting 10 years to age 70 for activating income to provide $35,000, it's only a $325,000
Capital requirement.
Correct. If I cut that in half to 5 years, the capital requirement jumps to $420,000. And if I want immediate income at age 70, guaranteed for the rest of my life, it's $560,000. So if I have $1 million portfolio and I'm trying to figure out how to create and meet the income need, income planning, we would argue what's most important to the consumer? Is it how much wealth I've created first, or is it meeting my income needs and making sure that I don't run out of money?
Yeah, and that's, you look at this slide, it's pretty powerful when you're saying, hey, I could buy the required income for retirement at 325, and the difference between that and the 4% safe withdrawal percentage, if I take that difference and invest it, I should be much better off, in a much better position, because I have equity exposure, I have underlying guaranteed lifetime income to meet my basic income needs. We're setting a floor for what we need. And doing that is huge for clients. Clients like paychecks. They're used to them through working years. Clients like pensions because it's guaranteed. So why not create your own private pension through a guaranteed income stream? And we're not saying all of your retirement. We're saying set an underlying floor with a portion of your funds so it frees up the equity component to be invested aggressively to grow.
Correct. And that's the thing. When you look at this here, certainly the annuity conversation is the G word in terms of what the income payment is. Mm-hmm. The income stream, the premium required to generate the payment amount of $35,000 is guaranteed.
Correct.
There's nothing controversial per se about that. The challenge becomes a lot of the times with annuities, the controversy comes into, well, do I trust the insurance company? What are the commissions? Are these high exorbitant commissions that favor the broker and not the client? And those things, I would contend, if you're doing the proper due diligence, finding the right solution, there's no controversy. If I have $1 million portfolio and I can deploy $325 to guarantee $35,000 of income, that problem is solved. I can take the remaining $675,000 and build out a wonderfully balanced investment portfolio combined with equities, fixed income, real assets, alternative investments. However, them and that advisor seem optimal or deem optimal. But at least I can shore up the income planning portion of it in a very efficient manner.
Correct. And it's been proven through many models that having that underlying guaranteed income stream helps alleviate the stress on the equity component and that safe withdrawal percentage. As we know, there's been discussions that is 4% a safe withdrawal percentage. Probably not. It's probably not, especially in volatile market conditions. It might be with the run we've had over the last 10 years, but where we're forecasting over the next few years, it's not. So having that guarantee to alleviate some of that withdrawal percentage stress on the equity part or the diversified portfolio part, we should say, definitely is beneficial.
The other element is, someone's asked, well, how can an insurance company afford to do this? The answer is mortality credits. Well, what is mortality credits? You want to answer?
No, you keep going. You're on a roll.
The insurance companies have the unique advantage to actuarially price a life expectancy and can guarantee those payments. No other institution can do that.
Correct. They know to a T because of the law of large numbers. They insure so many lives that some people are going to die soon, some people are going to die late, and they can put an exact number actuarially on the average life expectancy so they can price the products to meet that.
And they price that risk.
Exactly right.
Whereas an individual household has no idea. I mean, the risk to longevity is incredibly significant.
Correct. Because if you shoot on your portfolio to last till age 90 and you live to 97, oh shoot, I run out of money.
Right.
So it is dramatic.
What else are you seeing in the annuity space as we wrap up here? What are you seeing?
Well, fixed rate for sure. Fixed rate are selling like hotcakes right now because they're outperforming most fixed rate options, CDs, bank CDs, money market accounts.
We're even seeing 5% fixed as an option on some index products, which we haven't seen in many years.
Exactly.
Many years.
Exactly. So your traditional CD buyer that might be getting 3.5 at a bank right now with non-tax deferred, no liquidity, they're looking for alternatives. And when they see advertised rates of 5% with tax deferment, that's pretty attractive. And so we're seeing a lot of people jumping into that fixed bucket right now. And I can't fault them, but I always pause and tell the advisors that I'm working with, consider an index annuity on a 5-year chassis, same product essentially, but you have much more upside potential to a cap rate of 9.5%, 10% on a 5-year product with, as you said, a fixed bucket of 4.5% to 5%. That seems to make more sense to me, where you have the guaranteed component, but more upside potential as well.
So talk to me a little about performance trigger.
My favorite indice option currently, just because I don't see double-digit returns coming in the next 12 months out of the, let's take the S&P 500, right? It's going to be flat or somewhere in the low.
Or negative or minimal.
Right?
Yeah.
So a performance...
It's a big question mark on what the upside performance is from here.
Correct. No one knows.
Right.
We're just simply making assumptions.
Yeah.
So I like the performance trigger because it's as simple as this. There's a specified rate. For instance, on a certain carrier, a performance trigger rate might be 9.5%. Okay, so that's the performance trigger rate. If that underlying index is flat at 0 or positive, any bit, flat or positive, you get the 9.5% rate. So take the S&P 500, if it is up 0.02%, you're getting the 9.5%.
So the S&P today, using exact numbers, it is a round number. It's 3,761. So 1 year, if the policy issued November 1 of 2022, the anniversary of October 31st, if the S&P is 3,762, they get 9.5.
Yep. And it doesn't have to be 62. It could be 61. And it could be identical to what it is today.
Got it.
And
As long as it's not 3,760, then they
Correct.
would get a 0.
flat, so identical to it is, or positive in any capacity, you get the declared rate.
They either get a 0 or they get 9.5.
Correct. Very simple to understand, explain to clients, and it takes a lot of the guessing work out of, well, what is the performance going to be out of the markets over the next 12 months?
And if they get the 9.5, is it credited and locked in?
That's what's great about annuities. Yeah, it's called an annual reset design. So yes, it credits that interest. You're locked in. You put 100,000 in. Now you got 109,500, and that is locked in. That's your new floor. You get to either reallocate or keep it in that same strategy and go forward from there.
Beautiful.
Beautiful
Anything
thing.
else?
No, it's very attractive in today's market.
Yes.
It really is. I think more people need to consider looking at index annuities as an alternative to some of their safe money or cash.
Well, certainly the 50-plus market boomers, retirees,
Correct.
pre-retirees, that is the marketplace for these types of instruments.
Exactly right.
All right. Thank you.
Of course.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment, or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.